Federal Reserve Chair Janet Yellen saying the upcoming Brexit vote played a role in its decision not to raise interest rates following its June policy meeting. And here to discuss this is Dean Maki, the chief economist at Point72 Asset Management. Dean, it's nice to see you. Welcome.
Thank you for having me on.
So what do you make of the Brexit side of things? Do you agree with Janet Yellen that a yes Brexit vote could pose risks for the U.S. economy?
I think it could pose certainly risk to U.S. markets and indirectly then to the economy to some extent. I don't think Brexit would cause a U.S. recession. I think that's very unlikely. I think it's much more of a risk for the UK and to Europe.
And whatever downside occurs from the U.S. point of view from the Brexit, is that a short-term risk? I mean, come July when the Fed meets again, are we going to be talking about Brexit?
I think if markets go into a swoon as a result of a positive vote to leave, that could affect the July decision. So it really, I think, is more of a market issue for the Fed than anything else.
Yeah, and the other interesting development from the Fed were indications of a slower pace of rate hikes going forward. So I want to put up this chart basically showing the dot plot of the FOMC. There you see that green line is the median Fed forecast of where short-term interest rates are going. And then the blue line below it is where the markets think interest rates are going. And you can see the spread is pretty big there. So what's going on here? Why aren't the markets and the Fed on the same page?
Well, this has been happening for quite some time now, where the Fed's been thinking they'd go at a more aggressive pace than markets believed. The Fed has really only encouraged markets to keep thinking this way because the Fed, for example, yesterday brought their line down a lot. And so market participants are of the view the Fed eventually is going to come to our view, and that the Fed hasn't trained the markets any other way.
So what does the Fed, though, need to do to sort of get the markets back on track with them, or at least more closely aligned? And then do they even care that the markets are so sort of far away from their thinking?
Well, I think the only way the Fed's going to credibly move markets is to actually raise rates. And the Fed has been unwilling to do that so far this year. So I think until the Fed actually does that, markets will continue to have this view. I think the Fed in the very short term isn't that troubled by this discrepancy because their view is if the Fed's correct, then markets eventually will adjust. I think, though, that this could create a dislocation down the road, where if the Fed actually does what they're planning to do, that adjustment in markets could be pretty abrupt.
You know, and the statement on Wednesday was very dovish, leaving July open for a rate hike, but I mean, it was very, very dovish. When do you think the next hike is coming?
Yeah, I mean, Chair Yellen said July was not impossible. That doesn't, it's not impossible. I'll be a pro tennis player someday, but it's probably not going to happen. And I think similarly, the Fed's not going to go in July. I think the data, the requirements are too high and too quick for that to happen. I think September is the first time that they'll really be in position to raise rates.
Although that could involve additional headwinds with the election being so close to that.
Yes, I don't think that will be the reason they don't move, though. I think if the data turns stronger and the employment numbers get better, I think the Fed will move even though the election is not that far away.
And growth that you're expecting this year, the U.S. economy?
I think it'll be another 2% year for the U.S. So that's about in line with what we've been seeing in recent years. It's not as fast as many people would like, but it is where we're at.
All right, Dean Maki from Point72 Asset Management, thank you for coming by.
Thank you.
I'm Scott Gamm, and you're watching The Street.